All right. Well, welcome everyone to session 3 of the East Transition to Practice course. Thank you all for joining us. Hopefully, for some of you, you've been to sessions 1 and 2, and this is your third session. And we got this one, and then session 4 coming up in December. So hopefully, you found some value in it thus far. And if you haven't, that's okay. We do have the links for the recorded sessions 1 and sessions 2 that I'll put the link up for at the end of this session. But thank you all for taking the time to join us. Today, we're going to focus entirely on Insurance 101. This is really not meant to be a deep dive into all this. I am not that far removed from where most of you are about trying to understand, as you sort of come out of training, trying to figure out how to protect yourself and your biggest investment, which is you. And insurance plays a role in that, whether we like it or not. And if you're anything like me, I came out totally ignorant, knowing none of these things, getting started, and it's really just very overwhelming. So our hope here was to have an expert in the topic, give everyone kind of a 30,000-foot ballpark view as to what to think about, types of insurance, big picture things to understand, and then hopefully sort of trigger some thoughts in yourselves, and then allow you to kind of go out and start getting information for yourselves, vet resources. So this is not meant to be a deep dive. And as we kind of move forward, it'll just sort of hopefully stimulate some thinking, some thoughts for you guys, and then stimulate you to kind of go ask some more questions and figure out some information on your own. We're very lucky to have Larry Keller with us today to talk about the insurance topic. He's a certified financial planner, and he's got a lot of other acronyms after his name that I don't know, is totally out of our field, but he's an expert in this by far. He's a founder of Physician Financial Services and has a lot of wealth and experience in just not just this topic, but specifically with physicians. He's spoken to the plastic surgery groups. I think the AASA or AAS or ASPS, right, Larry, that you'd spoken to
Yep.
before. So we're really lucky to have him. He'll give us kind of about a 20-30 minute talk about insurance related topics, and then we'll have an open Q&A afterwards for any questions or concerns that y'all have. And with that, I'll let Larry take over.
Perfect. Thank you guys so much. So, you're 100% right. None of this is designed to make anybody, an expert. But what you'll find is the information that I'm going to give you can be invaluable. What you're going to find is you're finishing your training. People are literally just coming at you. In fact, financial planners and insurance agents can buy a list that is essentially called the new in practice physician list. And I can find out where you went to medical school. I could get your birthday. I can find out where you are in terms of your training. And at the time that I know that you're transitioning to be earning a substantial income, you're still no better off than you were before. There's a lot that you don't know. So hopefully, if nothing else, this will tingle your spidey senses as to know whether something is right or something is wrong. But no matter what, certainly do your due diligence when it comes to insurance or financial planning. So let's look at our first one, and we're just going to go with the rules of insurance. And we say, don't insure risks that you can afford to pay out of your own pocket. So if you're like me and you've gone to, let's say, Best Buy or an electronics store, and you've gone out and you've bought, headphones, and they are stopping you at the register and they ask you if you want insurance with that, your answer should be no. Now, they're probably going to ask you at least 3 times, and the answer should always be no. Now, because you guys are physicians and not doctors, you are not going to take the approach that I take on the 3rd time. I'll usually say, I've told you no twice. Now I'm going to tell you a 3rd time. Do you want to know what I do for a living? And they're going to come back and they're going to say, probably nothing. And I say, that's right. I'm an insurance agent. You don't buy insurance for an inconvenience. You buy insurance against a financial catastrophe. And that's going to be something like disability. You've lost your ability to earn income. Death, sickness or injury, that's your health insurance. Occupation-related liability, that's what you have medical malpractice for. Destruction of expensive property. And then you have your non-occupation related liabilities, slip and fall, if you have children and they're playing at somebody else's house and they're kids and they're playing baseball and one hits the other one with a baseball bat accidentally, you really need to have coverage for things like that. But offense sells tickets. Defense wins championships. So I can tell you, before we go to the offense, even though it's not sexy, even though no one wants to talk about this for the most part, other than insurance agents, we might find this exciting. Physicians generally don't. It is a necessary, evil. So here's the good news. You guys are going to earn substantial incomes. And if you're still in training, it's not that far away. And if we look at the 2025 Medscape salary survey, the average income for a general surgeon was $420,000 annually. So let's say you finish at age 32, you practice from age 32 to age 65 with a 3% raise. Believe it or not, you're going to earn over $24 million. Now, when I hear this, what do I think about? I mean, I'm thinking about surgeons and physicians because I know the numbers. You guys are probably thinking anything but that being you. You're thinking about movie stars. You're thinking about professional athletes. And the one thing that any financial plan is predicated upon is money going into the plan. And if you become too sick or too hurt to work, the money machine shuts down. But what do we routinely do? We go out and we buy a car, or we buy jewelry, or we buy a house. And the first thing that we need to do is to go out and insure that. And of course, auto insurance is mandatory. If we're going to buy a home and we're going to get a mortgage, that's going to be mandatory. Disability insurance really is not mandatory, but learning about it early, is the key. So if you work for a hospital, a large practice, a multi-specialty clinic, the odds are very good you're going to be provided with group long-term disability insurance. And this is going to become a part of your disability insurance plan, but it should not solely be your disability insurance plan. And it's going to cover a percentage of your salary up to a maximum monthly benefit. So it might say something like, as part of your benefits package, we provide long-term disability coverage. It's going to cover 60% of your salary with a maximum monthly benefit of, let's say, $10,000. And it's certainly not bad. But if you do the math, 60% of $200,000 is going to give me $120,000 a year. That's my $10,000 a month. Anything that I'm earning above $200,000, I have no coverage for. I also know that my benefits are generally going to be taxable. So I'm down to 60%, and that 60% of my $200,000 income is taxed. So that's not 60% anymore. Typically, it will cover your base salary. It's not going to cover overtime, incentive pay, shift differential, bonuses, RVUs, WRVUs. We'll talk about this. It's typically not going to be own occupation. It's going to require a loss of income in addition to your inability to do one or more of your job duties. It's likely subject to what they call ERISA, which is the Employee Retirement Income Security Act of 1974. All that you need to know is that the claims process is different compared to individual policies. But there is good news. It does not require medical underwriting. Typically, if you go into this right away, if you're participating in hazardous sports, rock climbing, mountain climbing, hang gliding, none of that matters. You're going to be insured for that under these plans. And again, it might not be anything that's portable for you. So then we have our individual disability insurance. And at the lower incomes, this can replace 60% of your salary. But as you earn more, that 60% drops tremendously. In fact, if your income was $1 million, you might be limited to $30,000 a month or something close to that. So now you're at a very low replacement ratio of your income. Benefits are generally income tax free. And there's special limits for residents, fellows, and what we call new in practice physicians. And that's typically in your last year of residency or any time during your fellowship. And regardless of what you're provided by your institution, you can purchase somewhere between $5,000 a month and $8,500 a month. And this is not what you're going to pay for the insurance. This is what you're going to receive from the insurance on a monthly basis. A really, really big thing for residents and fellows or very recent graduates, you're going to look for a guaranteed standard issue policy. And is this available at my institution? And we'll talk about that in detail. This is a portable policy that you own that can be increased as your income rises. And generally, you want to avoid buying your policy in California if possible. So if you're doing general surgery and you're in California for that, but you're going to be doing fellowship outside of California, ideally, you would rather buy your policy outside of California, even if your plan is to return to California. California is the most expensive state for disability insurance. So what do you need to know? You're like, okay, this guy seems to be making some kind of sense here. I do see that I am my most valuable asset. So I go to the internet and I type in disability insurance for trauma surgery fellow, disability insurance for critical care surgeon. And you see all these paid ads or sponsored ads come up. And it says, get your free quote. And you do, you start entering in some of your information, which is completely legitimate. And in comes a spreadsheet. And when I see a spreadsheet, I'm not going to lie. It makes me angry. Spreadsheet is a tool, but a spreadsheet really speaks to the person that designed it, what they think is important, which might be very different than what you think is important. They might have created the spreadsheet not knowing what concerns you. And if you don't know the right questions to ask, you're going to potentially make a very big decision with minimal information, typically based on the lowest cost, because we're all going to revert to what we know, which is price. So if you see a spreadsheet and you don't see illustrations of coverage that are created by the insurance company's software program, right away, your spidey sense should go off and you will know I am looking at something that's very limited, that's probably going to give minimal value to me, and it's going to lead me to one thing and one thing only, the lowest price. In the same way you're talking to your physician. And I would imagine people are not researching their trauma surgeon, right? You guys are there. You guys are the heroes. You guys are going in to get these people better. But let's say I was an aesthetic plastic surgeon and I'm having elective surgery done. I would probably ask my plastic surgeon, how long have you been doing this? Are you board certified? If you are, in what specialties? Did you do a fellowship in aesthetic surgery? How many types of these cases have you done? Can I look at your before and after photos? At least you'll know who you're talking to. In the insurance and financial planning world, generally people don't do that. People go to the internet. People will ask their attendings, who's your agent? Who's your financial planner? And based on that and that alone, trust is created. But the attending, even if they're referring the person, they're really not necessarily familiar with the insurance marketplace or the credentials that a financial planner has or what their areas of specialty are. When it comes to disability insurance, there's only two questions that you must ask if you're a resident, fellow, or new graduate. Number one is, hi, I'm looking at disability insurance. Can you tell me, do you have access to something that is exclusive, like a discount or a guaranteed standard issue plan that you can provide to me? Yes or no? If the answer is yes, you're in the right ballpark and you're talking to the right person. If the answer is no, and they're not going to like it, you have to go to the second question. I understand that you don't have access to something that's exclusive, like a discount or a guaranteed standard issue plan. Do you know of one that is available to me, even if you cannot provide it? And if you do, can you give me the name and contact information for that endorsed agent? It doesn't mean that I'm going to go buy my policy from that agent, but I need to have all of the factors in my mind for comparison so I can actually make an educated decision. If you're not doing that, and there is a guaranteed standard issue plan at your hospital, you might make yourself inadvertently ineligible for the guaranteed standard issue plan. And we'll talk about how important that offering might be. Then we're going to talk about the big five. These are just the companies that are most well known for having own occupation or own specialty coverage. And really finding the right disability policy is as easy as 1, 2, 3. So what do I look for in an individual disability policy? We want it to be non-cancelable and guaranteed renewable. And this sounds ever so scary, but it just means the insurance company cannot take it away. They cannot change the premium rates. You can get rid of them. They cannot get rid of you. We're going to talk about this because if you're going to blow it, it's going to be here. The own occupation definition of total disability. This is a must for trauma surgeons. We're going to talk about the residual or partial rider. We're going to talk about the recovery benefit, the cost of living adjustment rider, and your means of increasing your coverage. So what is true own occupation and the big five? So let's talk about true own occupation first. This is your definition. This is your withdrawal slip from the bank if you're going to an ATM. This is going to state that you're unable to perform the material and substantial duties of your occupation. And it's not what you're board certified in. It's not what you call yourself. It is what your job duties are. And your job duties are going to determine what it is your occupation is. And your disability is going to determine what you can or cannot do. This is always based on the duties you were doing immediately prior to your disability. So if you were a general surgery resident when you bought it, and now you're a trauma surgeon doing trauma and critical care, it's going to cover you as a trauma critical care surgeon. You do not need to inform the insurance company. You do not need to call your agent. This will happen just based on the fact that you have changed your occupation. You can also let the insurance companies know when you increase your coverage, because it's going to ask, what is your occupation? And of course, you would let them know at the time of claim, because you're going to tell them, this is what I was doing, and this is what I can no longer do. If you're totally disabled from your regular occupation, so let's just say I'm solely doing trauma surgery, and I'm disabled and I can no longer work as a traumatic surgeon, I am deemed totally disabled. If I can work in another occupation or another medical specialty, it has no impact on my benefit, and full benefits are paid, plus whatever else I can earn in another occupation or medical specialty. The big five happen to be Berkshire, which is Guardian. You can use them interchangeably. Standard Insurance Company, Mass Mutual, Principal, and Emeritus. You can add to this Northwestern Mutual and New York Life. A caveat to Northwestern Mutual is from September of 1997 up until December of 2022, they did not offer true own occupation. They had something that sounded like it, but it was not exactly this. And if you worked and you earned an income doing anything, your benefits could be potentially reduced, if not eliminated entirely. That problem was fixed in December of 2022. They offer several definitions. So just because the definition is available does not necessarily mean that that is the definition that is in your policy. And New York Life came up with a policy 2 or 3 years ago. It's fairly expensive compared to everybody else on the board. So if you have New York Life, the policy is good. You really should look at the pricing as to how other insurance companies compare. Now, trauma and critical care surgery is unique because on one hand, you guys are surgeons, but on the other hand, you're critical care physicians. And it's very common for a surgeon or a critical care surgeon to ask me, Larry, if I'm disabled and I can't operate, but I can still do critical care, I can still go to the SICU, and I earn money doing that, am I going to get my full benefit? And generally the answer is, I really don't know. Tell me a little bit more about what your mix was. How much were you doing in terms of trauma surgery? How much were you doing in terms of surgical critical care? And if you had a pretty good mix, and let's say you were 60% surgery and 40% critical care, you likely would not be deemed totally disabled. And they would essentially say, you've got 60% of your income coming from surgery. If you can't operate, you've got a 60% loss of your income. In the first month, we're going to pay you proportionally. We'll give you 60% of your 100% benefit. But trauma surgeons are type A personalities. You're going to work. You're going to likely take the time that you were spending in the OR, and now you're going to shift that over to doing surgical critical care. And the problem is, if you're considered partially disabled and you're getting paid based on loss of income, if you've now shifted your income from surgery to critical care, your loss of income from the inability to do surgery is actually going down. And if you get to the point that you don't have the required loss of income, which is typically 15 or 20%, your benefits could stop entirely. So what Guardian did about 6 years ago is they created something called the Enhanced Medical Specialty Definition. And before they say, well, doc, you had 2 different jobs. You were a surgeon and you were a critical care physician. You can't do surgery. You could still do the critical care, and we're going to pay you based on loss of income. Just don't earn too much on the other side or your benefits could end. They take a step back and they say, prior to your disability was more than half of your income derived from performing invasive or surgical procedures. And if the answer is yes, using my example of 60%, you are immediately deemed totally disabled. Full benefits are payable. Even if you do 100% in the surgical ICU with no loss of income, you still receive your full disability benefits plus what you're earning as a critical care physician. This is really the difference between getting your full payment and getting a partial payment. So again, for a hybrid occupation or a hybrid medical specialty, this can be something that's very important. Same thing is true if you happen to be very entrepreneurial and you're like, hey, I'm a surgeon, but I'm in an academic institution. I have my surgical practice, but I also teach residents. I have protected research time, and I'm doing administrative duties. Here's our residual, and this is where most claims are. Something's going on. You don't feel great. You're typically going to curbside one of your friends in the hallway, and they tell you, you don't look great. you can still work. You can still do trauma surgery. You could still do surgical critical care. But you really have to work fewer days per week, fewer hours per day, fewer cases, fewer procedures, and you're going to have a loss of income. Well, if you're still doing your job, but you have a loss of income doing it, own occupation, even with Guardian, unless you have more than a 50% loss, it does nothing for you. It's like pregnancy. You either are or you're not. So if I ask you if you're doing your job and you're like, yes, I am working as a trauma surgeon, but, and you try to tell me a whole bunch of disclaimers, but I can only do cases Monday and Tuesday morning from 8 to 2, the answer is yes, you're working as a trauma surgeon. So you need something that takes away the all or nothing. Many disabilities are gradual and not immediate. This will generally pay you a percentage of your total disability benefit. Typically, you need a 15 to 20% loss of income. And in any given month, if you have a loss of more than 75 or 80%, you're going to get everything. If you find a lot of your compensation is tied to productivity or RVUs or WRVUs, and now you've returned after a period of total disability, you really want your benefits to continue based on loss of income only. So if you go back and your doctor says you can do everything you used to do, same number of hours or more, and all you have is a loss of income, you need a provision in your policy that says, as long as that loss was due to your prior disability, we're going to continue to pay you. And we're going to continue to pay you potentially until your age of 65 or longer. One of the companies has a limited recovery benefit, and it ends after 12 months. So does that mean it's completely wrong? Not necessarily, but does it mean you should be cognizant of how long the recovery benefit in the policy is? Absolutely. You've got your cost of living adjustment rider. Nothing sexy here. This is just going to increase your benefit after disability has lasted for a year. The younger you are, the more you have in terms of debt, the less you have in terms of income, the more important this is. Someone that's disabled in their early 30s, they potentially have a 30-year claim horizon. Someone that's disabled in their 50s, you're probably looking at more like 10 or 12 years. So if cost is an issue and you don't think you're going to increase your coverage shortly after buying it, like within a couple of years, you might want to just buy a larger policy and forgo the COLA rider entirely. So other than price, what should you know? How are claims handled for mental or nervous conditions like anxiety, depression, stress, chemical dependency? How are claims handled if I'm disabled and I choose to reside overseas? Or what if I'm a visa holder and I'm forced to return to my country of citizenship because I've lost my sponsorship? And then what kind of increase option do I want in my policy? This is my mechanism to buy more as my income rises. So mental and nervous or substance abuse disorders, typically policies are going to come with a 2-year limit for these claims. So this is your psychiatric-based claims: anxiety, depression, stress, chemical dependency, drug addiction, burnout. If you have medical history, like ADD, ADHD, you're on an SSRI, you're in therapy, you're going to get typically an exclusion rider or no coverage for these types of claims. This is not going to apply to something like dementia as a result of a stroke, a trauma, a head injury, viral infection, MS, or Parkinson's. If I'm a visa holder, there's only one company where you're a visa holder, become disabled in the United States, need to return to your country of citizenship, and still receive full benefits with no limitation. That happens to be Guardian. It is not in all states. If you're in states like California, Delaware, Florida, Montana, North Dakota, New York, South Carolina, South Dakota, or Wyoming, there's going to be another limitation associated with that. But outside of those states, Guardian will say, if you are a citizen of country X and your disability began in the United States, and now you must return to your country of citizenship, you will continue to receive benefits with no limitations. By the same token, if you were outside the United States visiting family and your plan was to come back within 31 days and your tickets were booked and you became disabled overseas and you cannot come back, as long as your plans were to come back and your tickets were booked within 31 days, that's considered incidental travel, and you will continue to receive benefits overseas with no limitation. Future increase option. I'm not going to dwell on this, but you're paying for the right to be able to buy more coverage as your income rises. The positive is, because you're paying for it, you cannot lose this. Every year your option comes up. If you qualify financially, you can choose to use it or not based on your individual needs, goals, and budget. Some companies will just add to your existing coverage. Other ones are going to give you a new policy for the additional coverage. All you really need to know is, what does my policy do? And am I comfortable with this type of increase option? Well, a newer type of increase option is called a benefit purchase rider, or a benefit update rider, or a benefit increase rider. The best way to think of this is like morphine. In the right hands, it's a miracle drug. In the wrong hands, it's downright dangerous. So you don't pay for the increase option, and you have the ability to get to the insurance company's maximum monthly benefit, which is typically $20,000 or $30,000. But the negative is, every 3 years, you typically have to check in with the insurance company. And you're going to fill out an application to see if you qualify for more coverage. If you don't check in after multiple attempts, the increase option is going to be removed from your policy. In some cases, this is going to be permanent. If you do check in and you don't qualify for additional coverage, there's nothing else you need to do. The insurance companies are not looking to make you into a walking moral hazard. But if you are eligible for more coverage, you must purchase at least half of what you qualify for. So if you're looking in the mirror and you're like, I am a brilliant physician, I am a better surgeon, but I will tell you, administratively, I am a disaster. I don't open my mail. I don't open emails. The agent can reach out to me as much as they want. The insurance company can notify me, and I'm probably never going to check in. Then proceed with caution for anything that starts with a B. In this case, the B typically stands for you better do something. Like I said, California is the most expensive state, limited policy choices. If you're not there, try to buy your policy before you get there. So everything I said so far is for people that are healthy, and the insurance company is willing to insure them by answering medical questions, reviewing their prescription drug history, reviewing their medical records. Unfortunately, a lot of physicians and a lot of residents, they're not so healthy. They have stuff that's just congenital, or they're doing things that cause problems, not in the medical world per se, but in what we call probability underwriting. Does having this increase your odds of becoming disabled? So I can tell you a significant number of policies that are applied for are either declined, or they're modified, where they're going to exclude certain conditions or specific body parts, or they're going to charge you more money. And the odds are really scary. What you'll find is more than half of the policies these days are either declined, postponed, or modified. So here's a couple of common reasons. Self-prescribing or peer prescribing. I cannot tell you how often I see this. I know that you're busy residents and fellows. You don't have time to go see a doctor. It's very easy to just write the script yourself. If it's something small, it's not a problem. But if you're self-prescribing Wellbutrin, if you're writing anti-anxiety medications for yourself, or anything of any large nature, that is likely going to get you declined. If you're currently pregnant or you have a history of pregnancy complications or infertility, you're not going to receive coverage for pregnancy or complications. If you've been diagnosed or treated for recent stress, anxiety, depression, you're in therapy, you have ADD, ADHD, you're taking Vyvanse or Adderall, you're going to get an exclusion rider for psychiatric claims. If you have diabetes or pre-diabetes, very popular among surgeons, you had a recent needle stick, the patient was negative, but you didn't get a negative HIV, hepatitis B, or hepatitis C test at least 6 months post-exposure. If you don't have that, you'll get insurance, but there's going to be an exclusion rider for bloodborne pathogens. So you really want to have the negative test that documents 6 months or later that you don't have it and you have not converted. Recent surgery or surgery where hardware was placed. So if you had shoulder surgery and you've got pinch screws and anchors in your shoulder, that shoulder is going to be excluded. For the most part, a cancer history, if you're seeing a chiropractor, even if you tell me it's a free massage, it's not so free, and I guarantee you that's not what your medical records say. If you have psoriasis or psoriatic arthritis, that's going to result in an exclusion rider for psoriasis. If you have the arthritic component, that's going to limit your payout to a maximum of 5 years, no increase options, and no coverage for arthritis or psoriasis. Recently diagnosed with sleep apnea or another sleep disorder. Gee, I can't think of any fellows that have that. Diagnosed with ulcerative colitis or Crohn's disease. So what is your saving grace? It's what I talked about before, the guaranteed standard issue plan. We love acronyms in insurance, GSI. There's either no medical questions or a couple of gatekeeper questions just to make sure you weren't diagnosed with cancer and now you want to buy this insurance. BMI, whether it's too high or too low, not taken into consideration. The insurance companies do not even ask. Hazardous activities, not taken into consideration. Martial arts, scuba diving, hang gliding, private piloting, does not matter. Like I said before, this might not be available if you were previously declined for individual coverage, if you were issued a modified policy, or in some cases you put an application in, your agent told you the Titanic was going to sink, and you need to withdraw your application. In some cases, you are now ineligible. So you really need to know before you do anything, is there a GSI plan at my hospital that's available to me, especially if you have medical issues, if you participate in hazardous activities, or your BMI might be an issue. It's the same or many of the same benefits of a standalone policy. Policies are typically portable. I wrote an article about this silent epidemic robbing medical residents of disability insurance. And it's literally all about agents that don't have access convincing residents and fellows to apply medically. They are declined or postponed or modified. They subsequently find out about the availability of a GSI plan. And with few exceptions, unfortunately, it's too late. So GSI plans are exclusive to a particular agent or group of agents. This is why potential clients are encouraged by non-endorsed agents to apply for coverage on a medically underwritten basis. And then because of this adverse action, they find themselves ineligible for the GSI program. You might hear that the cost of a GSI plan is more expensive compared to a medically underwritten plan. That is not true. The cost of a GSI plan is the same or less compared to a fully underwritten policy. And here's the hard numbers. According to the Milliman 2024 annual survey of the U.S. individual disability income insurance market, 53% of individual disability policies are either modified, 34%, or 19% were declined. So think about this. People run to Vegas to go play blackjack because the odds are about 50-50. The odds here are 53% against you. Why play the game if you've already won and there's a GSI plan available? Okay, so that's my disability insurance section. Any immediate questions jumping out at you guys? And then I'll head on to life insurance and finish up with the umbrella policies. Anything jumping out? All right, then we're going to just plow on and look for questions as we get towards the end. So let's go back and let's look at life insurance. And I will tell you, what I see a lot of is life insurance that is sold at inappropriate times, to medical residents or fellows. And what we'll find is that there's so many different types of life insurance. We find that we've got term life insurance, we've got whole life insurance, we've got universal life insurance, we've got variable universal life insurance, we've got equity indexed universal life insurance. And really, the only thing that you need to know here is residents, fellows, and early career physicians should not even be thinking about anything other than term life insurance. And the term life insurance that you should be thinking about is not annual renewable term, or ART, or yearly renewable term, YRT. What you should be thinking about is what's called level premium term life insurance. And this is where you're paying a fixed premium rate. You know what it's going to be, you know what the cost is, and it's going to be the same anywhere from 10 years to as long as 40 years. And it's typically going to be in 5-year increments. One company will actually do guaranteed level premium term from year 16 to year 30 in 1-year increments. I've used that in a couple of unique situations. But term insurance, it's death benefit only. I die, my beneficiary is going to get money. It's going to provide the largest amount for the lowest cost. Like I said, you want what is called a level premium term. When you see something that says yearly renewable term or annual renewable term, the only thing you really need to do is run. And there's a couple of companies where the agents are selling this. And the best way to think about it is you're going to see 2 columns. And it's going to say current non-guaranteed premium rate. And then you're going to see another column that says guaranteed maximum premium rate. And maybe for the first couple of years, the non-guaranteed and the guaranteed are going to match up with each other. But typically, after about 5 years, they're not. And you might find that something that was $500 in the first 5 years, in year 6 is now $800, but it could go up to as much as $3,200 in that year. And you're not going to know what it goes up to until your policy comes up for renewal. So this begs the question, why would an agent be showing this to their physician clients? And the answer is they want the rate to get more expensive. They want you to call them and complain that the premium is increasing. And then they're going to say something to the effect of, well, doctor, let me ask you something. Do you rent your home or do you own your home? And if you're practicing, you're probably going to say, Do I own my home? I don't rent, but the bank owns most of it. And they'll say, well, that's interesting. Why did you choose to own? Well, I don't want to pay somebody else's mortgage. I want to develop equity. I want to have my liabilities going down and my assets going up. Then they're going to look to parlay that into some type of cash value life insurance. And they're going to say, well, doctor, if you don't want to rent your home, you don't want to rent your insurance. You have a provision in the policy that will allow you to switch from term insurance to some type of cash value insurance, like I described in my earlier life insurance slide. And the good news is you can do this regardless of your health by signing a couple of pieces of paper. And unless you know what you're getting into and you understand the pros and the cons associated with this cash value life insurance, they're leading you down a path of mixing insurance and investing. And a general rule of thumb is not to mix your insurance and your investments. Your insurance should stay as your insurance. Your investment should stay as your investments. And they really cannot coexist well in the same world. And if you think about it, it makes sense. Insurance is about transferring the risk away from you to a third party that we call the insurance company. Investing is about taking on more risk in hope of getting a greater rate of return. So on one hand, you're trying to transfer risk. On the other hand, you're trying to take risk. This is like the Odd Couple. It's like Felix and Oscar living together. It makes for a great show and it's entertaining, but generally it just does not work. So typically residents and fellows should purchase this type of life insurance. If you plan on starting a private practice, the odds are very good you're going to take out a loan. And the bank is going to look for collateral for the loan. Don't look to buy your term life insurance to collateralize your loan a week before you're going to supposedly close on your loan. You want to do this well in advance. So why would you buy term life insurance? The reason that you would buy it is you're married and you love your spouse. But let's go say you don't love your spouse, but you have kids and you love them. Buy some term life insurance. Or maybe you have a family history and things are good for you, but you have a brother and a sister and they have been diagnosed with diabetes. You have not. Buy term life insurance when you're young and healthy to lock into a favorable underwriting classification so you have a low cost associated with your policy. But you've got permanent insurance, but first and foremost, you want or you need permanent death benefit. A big thing that physicians forget, life insurance is not for you. This is for your survivors. So it's not about being an asset protection plan. It's not about a supplemental retirement plan. But could you use it for that? Yeah, maybe if you've maxed out all your tax deductible, tax deferred, or tax-free investment options. You own your home. You're not renting. You funded for your children's college educations. You understand that generally you're not going to break even cash on cash for 10 years. You can afford to and you can commit paying the premiums and you value the other aspects of the policy. But you got to go into this with eyes wide open and understand what the negatives are. Do some research online. And if you keep reading all the things that are negative and you still think it might be for you, maybe it is. But most of the stuff that you're going to read about this that's favorable is typically written by somebody that sells it, or it's an independent study that's been funded by the insurance company. As we close in this section, there's something called an umbrella policy. So you've got your auto insurance. Hopefully you've got renter's insurance. Clearly you have medical malpractice insurance. And let's say you're driving your car, it's a rainy day, and you jam on the brakes and you accidentally hit the car in front of you. And you have auto insurance. Let's say that you've got a $500,000 liability limit. You've got a $500 deductible. The person finds out that not only are you a physician, you are a surgeon. All that they are seeing is dollar signs. So they sue you and they get a judgment against you for $2 million. And your liability limit, the maximum is $500,000. So they won $2 million, you have $500,000. You're $1.5 million short. Where is that coming from? If you don't have the assets, it's coming out of your future earnings, and your wages might be garnished. So this is what's known as an excess liability policy, and it just extends the liability limits on your auto and your homeowner's policies. And this is secondary coverage that works in conjunction with what I just described, your primary coverage. When the limit of your primary policy is exhausted, in comes the umbrella. And the limits on your homeowners and your auto insurance should be the same. But very often I'll see something like, I don't know, $500,000 on someone's auto insurance and $250,000 on their home. But if you live in the Northeast and you get all sorts of ice and snow, and you come home one day and you find the mailman laid out doing snow angels on your lawn, you guys are surgeons. I would imagine your gut reaction is to check for a pulse, make sure they're okay, maybe call 911, and you're off to the races. That's not me. If I have $500,000 on my car and only $250,000 on my home, I'm not looking for a pulse. I'm going to pick that guy up off my lawn and I'm throwing him on the hood of my car because I've got $250,000 more coverage there than I do on my lawn. So because we don't know where things are going to happen, I would equalize the liability limits on my homeowners and my auto policy. I would avoid low deductibles. You know, if you've got a $250 deductible or a $500 or $1,000 deductible, I can tell you, you're not even going to want to fill out the paperwork for the claim. Maybe on your car, it should be $2,500. On your house, it should be $5,000. If something's going to happen in your home, it's going to be something big. So this will reduce your premium. And you could take the savings to go buy your umbrella policy where you really need it on the back end. So think of this like a game of chess. The pieces are on the board. You're just repositioning them to be more favorable for you. But what's excluded by an umbrella policy? Intentional damage caused by you or a member of your family or household. Damages that arise out of a business or professional pursuit, including malpractice. So you can't buy an umbrella policy to protect against your own malpractice. There's basically nothing you can do for that other than buy med-mal insurance. There's entities that you can form. There's other insurance you can buy for your employees. But for your own malpractice, there's really not much that you can do. For liability that you accept under the terms of a contract or agreement, that's going to be excluded. Liability related to ownership, maintenance, and use of an aircraft, a non-traditional watercraft like jet ski, most recreational vehicles, unless they're scheduled on your policy, then that can be included, or damage to property owned, used, or maintained by you. And something under workers' compensation, if you get hurt on the job, that's not going to be, covered under your umbrella policy. Liability resulting from war or insurrection, and you want to make sure you have enough liability coverage to protect your assets. So good rule of thumb is if you have $3 million in assets, have a $3 million umbrella policy. If you got $5 million in assets, have a $5 million umbrella policy. Umbrella policies are extremely inexpensive. And some will say I'm not the most social guy in the world. But one of the reasons why I'm not so social is I don't want to have people in my house. So you have to consider factors like how often do you have guests in your home, right? How much do you drive? Do you have teenage drivers at home? Do you have something like a trampoline in your house? Do you have a pool in your house? You know, as much as these things are fun, they can really lead to destruction in terms of lawsuits and in terms of judgments. So what are my takeaways? And then we're going to answer a bunch of questions, I hope. We know this. You've worked hard. You want to protect the investment you've made in your career. Like patients, every individual is different. It's not one size fits all. And as much as we are well-oiled, highly skilled, highly educated money-making machines, not everything in life is in our control. Don't leave it to luck. I can tell you, most people don't plan to fail, but they absolutely fail to plan. Like, you would never go into a case with no surgical plan. So why would you go into practice or into a business agreement or sign a legal document without having it checked out? So here's how you find me. If you have disability insurance and you want it reviewed, if you're looking at disability insurance quotes, if you have life insurance, you want it reviewed, you're just looking for an opinion, don't be afraid. You can email me. It's lkeller@physicianfinancialservices.com. You can call me, 516-677-6211. If you want to know if there's a guaranteed standard issue plan at your hospital, I pretty much know where they are. I know who the agents are that have them, and that will be important for you to know. So I'm happy to take any questions that you guys have. I see we got a couple of things, in the chat here. So let's see what we got. All right, no questions in the chat, so we leave it up to you guys.
But so Larry, thank you so much for that information. I'll tell you, for most of you guys who are listening, I'm 13 years out now. I wish I'd had somebody like Larry telling me these things when I came out. I'll tell you, because Larry mentioned it, I was lucky not to make any major mistakes, but I did make a small mistake when I first started because I didn't know the difference, and I ended up talking to an agent that was not as scrupulous, and I ended up signing up for a whole life policy right out of fellowship. And luckily, I learned my lesson quick, and I only had about 3 or 4 months of premiums to pay. But not to say that it's a bad thing. It just, like Larry said, it really depends on your situation and station in life. And so, even if you don't take a lot away from this, just realize that a little bit of forward thinking, a little bit of thought and timing really matters a lot for this kind of stuff. I'll tell you another thing that's a big issue is people don't realize is, previous health history and medical problems can be a big part of the exclusionary things for all these policies. So this is why what's one of the benefits when you're young and you're healthy, when you're a resident. I remember I was not that far removed. It's like, oh, I don't have money for that. I don't want to spend money on that. I don't need that. And that's okay. That's not necessarily wrong, but what this is a little bit of forward thought protects you from yourself down the road, because if you're 5 years down, 10 years down, and then develop hypertension, diabetes, anxiety, any of these things will end up being exclusions. So thinking about these things and investigating for yourselves about whether there'll be a good solution for you on the front end is probably worth your time and some effort on your part. So we'll now open it up. Feel free, open forum for anyone who has any questions. Feel free to ask. I mean, Larry's a wealth of knowledge, and I'm happy to sort of chime into with my personal experience. I'm not an expert like Larry is, but I can kind of walk you through some things that I did and mistakes that I made if it will happen, if it will help. We're happy to answer any questions you guys have.
Some might say with your mistakes, you're more of an expert than I am, right?
Well, I've definitely learned some lessons.
Yes. So I would say, some people will ask me, well, when is a cash value policy right? Right. So there's different types of policies, and a lot of times cash value insurance is not right. But when do I need something that's permanent or longer than a term? And I could think of 3 types for this. So the first one is you have a disabled child. And you're not going to be working forever. You're not going to be alive forever, but this child is going to be around and they're going to need some help and they have special needs. So you could buy a life insurance policy, think of it like permanent term insurance, and put that into what's known as a special needs trust, and that's going to leave money for that child. If you want to leave money to a charitable foundation, So, the American Society of Plastic Surgeons has something like this. They call it the Plastic Surgery Foundation. And a lot of younger plastic surgeons really want to get involved with the society and the foundation, but they lack the money, right? So what do you do if you want to be involved and you want to be recognized, but you don't have the cash because you can't donate $50,000? Your spouse is going to go crazy. You've got young kids, you got kids to pay for, you got rent. So you can actually buy a small policy, same type of thing, permanent term insurance, where the foundation is the owner and the beneficiary of the policy. You gift the money to the society. You're the person that's insured. And at your death, the money goes to the foundation. So that's another time that cash value life insurance can work well. And I wish that this was the case for all of you. But let's say you're so wealthy, there is something that's called estate taxes. So if Avi and I were married and we've got all this money together and we're basically well in excess of what the exclusion amount is, and we want to leave money to our kids and not so much the government, once we exceed this amount, 60% goes to our kids and 40% goes to the government. So we can figure out what the estate tax is going to be, buy a policy that actually insures both of us. They call this a second to die policy. It doesn't pay on the first death. It pays on the second death when the taxes are due. And the beneficiary of that happens to be an irrevocable trust. But that's a pretty advanced estate planning talk. Besides those three things, I really just don't see it.
And I think the way it was sort of sold to me was, when I was younger and ignorant, is that, well, it's like you'd use the analogy renting versus buying a policy, but the benefit that they were sold to me is, well, you get your life insurance, but you're also putting money away that you can use as a vehicle for retirement or for savings. And, yeah, that is not wrong, but if provided that you're filling every other bucket, as you said, if every other thing is filled and you're doing your 401k, your 403b, your 529 fund for your college kids, and everything else is done, and you just happen to have money laying around, then yeah, it's not unreasonable, but typically that's going to be for people later in life, not generally people coming straight out of training. And correct me if I'm wrong, but that was the analogy that was sort of used to get me to do it. It sounded great, but didn't really explain the nuances of that decision making.
Yes, and the same thing is true, and you guys might hear this when you're done with your training. Oh, you're a practicing surgeon. Oh, you make too much money. You can't qualify for a Roth IRA. So you could buy this policy, and we'll call this the Roth IRA alternative, and just take the same amount of money you would have been able to put into a Roth, but you can't, put it into the life insurance, and now you've got the death benefit plus disability protection, plus you could take the money out tax-free via policy loans. But there is something beyond the scope of this that they call a backdoor Roth IRA. And that would be something that you would do well before buying cash value life insurance, especially under that concept.
Any other questions that anyone has? And I think Mark just made a comment in the chat, the cost difference between term and whole life, he's got a good point. The difference, you take that and put in index funds, you probably make more money long term, which I think is probably what most some financial planners would probably tell you.
Oh, 100%. And here's the other thing too, is you don't get both. You don't get the death benefit and the cash value if you have whole life insurance. You get one or the other. At least if you have your term insurance and you're investing in low-cost index funds, you have greater liquidity and you'll actually get both, or your heirs would get both. So that's a very valid point. And I agree, index funds are really where it's at. It's slow, it's boring, the cost is low. People that want to sell what's known as loaded mutual funds, they'll say something like, Mark, when you go to a restaurant, like, are you the kind of guy that like wants to go get served by the waiter and you're not going to leave a tip, or you're going to leave like a really bad tip? And they're hoping that you'd be, no, I would never do that. Well, the answer is you want to do it here, because what you don't pay in fees, you get to keep, which means you get to retire sooner, wealthier, or ideally both. So financial planners have a great role and they have a very good mission. But when people think about financial planners, they're thinking about investments. And that's a very, very small portion of what financial planners do. The ideal financial planner to me is what's known as fee only, right? They're like an Uber driver. You're paying them for their advice. You can take the advice or not. You just say, I want to get from point A to point B. If you want to make a stop, tell them you want to make a stop, but they want to get you there as soon as possible. And they're not selling products. If they're a fee-based planner, the best way to think about that in your world is the Stark Law. So wait a second. I got to come to you for the diagnosis, and then you're going to refer me to the drugstore and you own 50% of that? I don't get it. So in my world, I look at it as you're either a planner, a product salesman, but you can't be both at the same time, right? So you got to watch for that, also. So you could ask someone if they say they're a financial planner and you really want to sound like you know what you're doing, you'll probably scare them. Oh, that's interesting. You're a financial planner. Are you commission only? Are you fee only? Or are you fee based? And if they come back and they say they're commission only, they're basically a product salesperson masquerading as a financial advisor. And that's okay if you want to buy a product or you know where the advice is coming from, but it's certainly going to be conflicted advice. And if you know that, at least you know how to evaluate what they're telling you.
And correct me if I'm wrong, one of the things I also learned about whole life policies and why the premiums are so expensive is, as you said, the first few years, most of your premiums going towards their fees and their bottom line. Like, it's not really going towards funding your account.
No, unless you're buying something that's called a high early cash value policy, or you're minimizing the death benefit and then you're adding a lot of extra money into what they call paid up additions. You're basically overfunding it. Then no, then you might find, let's say on $1 million whole life policy for a 32-year-old, it might be $1,000 a month, so $12,000 a year. The cash value at the end of year one is zero. Next year, you put in another 12. Now you're at 24,000. Your cash value is, you guessed it, zero. Third year in, now I'm 36,000 in. My cash value is $4,000. You're typically not going to be even cash on cash until about 12 or 13 years. So some people might say, well, this is great. I got all my money back. Like, well, no, you gave up your interest for 12 or 13 years. That needs to be factored into the equation. So some people really do like it, and it is a safe vehicle. And in certain states, it can work for asset protection. But first and foremost, if you're not buying it as what it is, which is life insurance, you're really buying it under almost a false pretense.
And again, this is not, this is just advice. You all have to evaluate your own situations. And I'm not nor is Larry knocking whole life policies or permanent life policies. It may be the right thing for you. I think the point here is just that advocate that you guys educate yourselves about what they are and what they mean and make a qualified decision about you and whether it's worthwhile for you. But I think for most people, the vast majority of people in your situations coming out of training probably would not benefit from a whole life policy for the reasons we articulated.
Yeah, and I would say if you make it through training and you do three things, so you buy your disability insurance, and as you're doing your research, you got to find out whether there's a guaranteed standard issue plan at the hospital. And if there is, that's going to be available for typically 90 to 180 days after you graduate. So it's not like you walk out and it's done. The second one I would say is if you're married or you have kids or you're going to start a practice, you want to have some term life insurance. Maybe you do your Roth IRA. And as you're getting your job, you want to make sure you have your employment contract reviewed by a high quality healthcare attorney. If they don't know what an RVU is or a WRVU is, it's time to move on to a different lawyer.
And we did discuss that in session 2. I'll post it momentarily, the link for the previous sessions. And, if you have questions about that, you can reach out to me as well, or anybody else that's been involved in the course, and we can help put you in contact with people if you don't have any resources.
And Mark is right
Certainly.
on the money. He's a great student, right? So in terms of asset protection, yes, IRAs are governed by state laws. 401ks are federal. 401ks have unlimited protection from creditors. Again, you can do asset protection planning with attorneys. Am I a huge fan of going out with an attorney and spending thousands of dollars against something that is likely not going to happen or your medical malpractice insurance could cover? No, I don't think you need to do that. But if you're doing proper estate planning and some of the vehicles you're using for estate planning have asset protection benefits, then I think that that's very worthwhile. But I wouldn't go out specifically looking to set up an asset protection strategy.
Larry, who should they go talk to in their hospitals if they want to investigate the guaranteed standard issue plan? Like, who do they ask? Who do they talk to? Who should they go to figure that out?
So in some cases, you can go to graduate medical education, but here's where it gets a little interesting. Some plans or some GSI plans are what's known as endorsed GSI offers. And the GME knows that they're there and they'll be able to tell you, oh, it is here. This is the name of the endorsed agent. You can go reach out to them. But there are many more non-endorsed GSI offers, and the GME does not even know that these exist. These are basically agents like myself went to the insurance company and we're like, hey, we do a lot of business with the residents and fellows at this hospital. Would you be willing, insurance company, to give us a guaranteed standard issue offer for the residents and fellows training at hospital XYZ? So you can go online, like I can tell you, Guardian has a list. If you just Google Guardian GSI hospitals, you're going to find, over 125 institutions that have them. It's not a complete list, so they're not all going to be there. But if you're familiar and you're speaking with friends that are dealing with insurance agents that are well known in the medical marketplace, you can ask them. They generally will know where the GSI plans are, who has them. If you go online or you even ask ChatGPT, hey, I'm at Vanderbilt University Medical Center. Can you tell me if there's a GSI plan and who the endorsed agent is? That might show up as well. But, if you're in a big name hospital with a lot of residents and fellows, the odds are very good that there is a GSI plan there. And if you take my 2-question approach, do you know of or have access to something? If the answer is no, hey, even though you don't have access, do you know of something that's here and you can refer me to that agent? That will usually work. If you hear no twice, I'm not saying that it cannot happen, because it can. It's just fairly unlikely. So that's when you send someone like me an email. Hey, I'm a resident or fellow at this hospital. Can you let me know, is there a GSI offer available to me? And, we'll be happy to tell you if there is one or if there isn't. And if I know that the agent is there and I have their contact information, I'm more than happy to provide that, to you.
And am I understanding correctly? So GSI plans are really only open to trainees, residents, and fellows. Like, it's so once you finish, other than that 180 days out, after that, like, physicians in practice don't have access to GSI plans, correct?
Much, much more rare. It's typically residents and fellows, and residents and fellows also have access to the most discounts and the largest discounts. And the reason the insurance companies want to get you in early is they know you're not earning a lot, but the potential is great. So if we're willing to give you, as a fellow, $7,500 a month or $8,000 a month, and you're only making $80,000 a year, you've got a lot to gain by protecting your future when you're young. The GSI plan is great because it's very convenient. The policies are typically approved in 24 to 48 hours. You don't have to open up the Pandora's box of someone's looking at my prescription history, someone's reviewing my medical records. I have to answer medical records. Like, I had someone the other day, and this can almost be branded as what you should not do. So this person had a quote unquote financial planner. that was speaking with them about student loans and retirement money. The conversation quickly turned to disability insurance. And they happened to be at my hospital where I have a GSI plan. And the agent was not me. And the agent said, look, there's a GSI plan here with Guardian. One of Guardian's rules is if you apply to Guardian medically, even if you get declined, you're still eligible for the GSI plan. So this person was not so unethical to make them ineligible, but they were unethical enough to waste a lot of their time. So they applied. The underwriting process took 5 months. The person got offered a policy that looked like Swiss cheese, right? It didn't cover their back. It didn't cover psychiatric claims. They were getting an exclusion rider for colon polyps. They had no increase options. It was a mess. So the girl went onto my website and requested a GSI quote and filled out all the information I needed to process her application. And I said, have you applied for coverage previously? Oh, well, yes. I'm like, what was the outcome? She's like, I don't know. Let me loop in my financial planner. And the financial planner came back and she said, oh, yeah, no, we applied. She wasn't declined. She got 4 exclusion riders and no increase options. So I called the girl and I said, look, I just want to let you know, I could have had your policy in 24 to 48 hours. I would imagine that over that 5 months, they went through your medical records, they went through your prescription history, you answered questions, they came back with more questions. You were not talking to a doctor, you were talking to a non-medical professional. How did that make you feel? And she goes, a tremendous waste of time. And I'm like, I know how you feel, because the agent knew that if you went to Guardian, even if you got chewed up and spit out, you could still get the guaranteed standard issue plan. But the truth is, she rolled the dice and she hoped that maybe you'd get through underwriting and you'd be able to buy something from her and she could get paid. Now that she saw you weren't going to take this policy, she didn't say, I'll get in touch with Larry, because she knew I would turn her down. She said, just go find Larry on the web. You'll find the hospital page. He'll get it done for you. And the trick that these agents play is they try to dump all the bad business into the GSI plan, and all of the good business goes somewhere else. And once you start doing that and you're not getting a spread of risk, the insurance company is going to shut down the GSI plan really, really quickly. So if you find and sign up for a GSI plan as a resident or fellow, when you finish, does it disappear? No, it's an individual policy that you take with you no matter where you practice. All that you have to do is update your address. So it's the same individual policy that you would buy medically. The maximum monthly benefit is typically $15,000. Standard insurance company just increased their limits to $20,000, which is substantial. And all of the GSI policies have a 2-year limit for psychiatric claims. But you know what? Certain medical specialties, not yours, but emergency medicine and anesthesia and pain management and all of the policies in the state of California, they have to have that anyway. So if you're in one of those specialties, you're not even getting the short end of the stick there. And if you're on an SSRI and you would normally get an exclusion, you're getting 2 years of benefits for a condition you already have. That's pretty good, right? So that's why I say it's really important to explore the GSI option.
Larry, you just brought up something I wanted to ask about, and for their benefit. Can you talk about the issue of portability or not portability? What does that mean and why does it matter?
Yeah, so portability just means, if you have your own personal policy, it's something that you own individually. It's like your luggage. You just take it with you. It doesn't matter where you go. If you have a group insurance plan, so let's say, you're a practicing physician, and I'll just make it up. Let's say you're at the, Baylor University College of Medicine, and they provide a substantial long-term disability benefit. Like for the most part, you can make up to $500,000, and short of the taxes that you're going to lose, you're pretty well insured. But let's say you're at Baylor for 10 years. And now you decide, I've been in the hospital system for 10 years. I just want to get out. Maybe I want to do locums. I want to have more flexibility. I want to potentially have more financial freedom, whatever it might be. And now you leave. Well, you're 10 years older. Can't change that. But if you didn't have a private policy, not only are you 10 years older, you're hoping that you're still in the same shape that you were 10 years earlier. So the best approach is typically to have an individual policy, typically purchased when you're a resident or fellow. Take it with you to the practice that you go to. Then we evaluate, well, what's your guaranteed salary? What benefits are you getting from that institution? And then we just program your private policy to wrap around the group plan. And now you really have the best of both worlds. Because remember, your individual policy is going to make up for any cap on the group plan. So use my 60% to $10,000 a month maximum. That covers the first 200,000 of income. If you're making 500, most of your salary is actually not insured, plus it's taxable. So when you're there, they work in conjunction with each other. And if you leave, you just take your individual plan with you. And depending upon where you go, you either increase it or not, subject to your new income and your new benefits package.
What is your experience on this? When I was at one of my previous academic jobs employed, the group policy actually ended up, when I investigated it, it was portable. So I was able to take it with me after I left. I just had to pay the premiums on my own.
It's fairly rare. Like when I've seen it, it's going to be a minimal benefit that it's portable for, or the definition might not be own occupation. So it might say something like, this is a common one. Avi, in order to be deemed totally disabled, you have to be unable to perform one or more of the material and substantial duties of your occupation, and you have a loss of income of more than 80% compared to your pre-disability income. So yeah, I might be disabled as a trauma surgeon, but if I go get a job working at a pharmaceutical company, and I don't have the 80% or more loss of income because I'm making more than 20% of what I was, I don't meet the definition of total disability anymore, right? So I have a client, he's an emergency medicine physician, he's an MD, MBA. He's totally disabled out of emergency medicine. He's working as a medical director. He's receiving his full disability benefit plus an annual cost of living adjustment, tax-free, in addition to what he's doing as a medical director. And that definition is really what allowed him to do that. So insurance is really nothing more than a legal contract, and you have to look at that the same way you'd look at any other legal contract. But by the same token, insurance is what's known as a unilateral contract, right? So it's drafted by the insurance company. You either take it or you leave it. Like there's no redlining, there's no negotiating. The terms of the policy have been filed with each state's insurance department. The premiums have been filed with each state's insurance department. There's really it. So it's kind of like take it or leave it. And in the real world of insurance, when you apply for insurance, your application is really what's considered an offer. I'm offering, I would like you guys to insure me. And then they'll either insure you or they'll come back with a counter offer. Avi, we will insure you, but we're not going to be able to cover your right shoulder. And at that point, you're either going to take it or you're going to leave it. So the GSI plans are great for that because you could have a pre-existing condition and you're okay. And that's true. Tax-free if it's purchased with after-tax funds. Some hospitals have what's called a tax choice. Some don't. So some of them basically will say, well, Mark, we're going to give you this. We're not including anything in your taxable income. It's part of your benefits package. If you become disabled, you need to pay tax on that benefit. Other hospitals might say, well, we're going to give you a choice. You can either not have it included in your income and the benefits are taxable if you're disabled, or you can elect to have the premium that we're paying on your behalf on your check, you'll pay tax on that. And now if you're disabled, the benefits will be income tax free. So it just depends upon what's made available at the institution. The private policies are really, for the most part, paid with post-tax dollars. And if you're an employee, you don't have a choice. Even if you're a business owner, short of being a C corporation, you don't have a choice.
Anybody else have any questions, any concerns you want to bring up? Okay, well, I've got one more.
Fire away.
So what if you're someone who already has some medical problems and you're very likely, I mean, I would benefit to talk to somebody about it, but if you think you're not going to qualify, are you just SOL? Like even if you've already got a history of something, even in your 20s or 30s, in terms of trying to get life insurance, trying to get disability insurance, what are their alternatives? Are there any options for those kinds of people?
Like everything else, it depends, right? So it depends upon what it is. So number one is if you're working for a hospital or a multi-specialty clinic or a practice, they probably have group long-term disability coverage for you. If you go into that right away, there's no medical underwriting. So up to a certain amount, you're going to get that. That's going to be guaranteed. A lot of the bigger places might even have a guaranteed standard issue plan. So they have group insurance and they say, well, Avi, this group insurance replaces a portion of your income, but we make available a supplemental individual policy with no medical underwriting for up to this amount. The worst thing that you're going to find there is a pre-existing conditions limitation. And it might say something like, okay, we're going to look back 3 months. And if you bought this policy and you saw a physician, took a prescription medication, a reasonably prudent individual would have seen a physician for the symptoms that they were having, you had diagnostic testing, and you got your 3-month look back, and then you file a claim within the first 12 months as a result of a pre-existing condition, that we're not going to pay. But beyond that, you're good to go. If there's no group plan, there's no GSI plan because you're doing locums and you're self-employed, then you could potentially go to Lloyd's of London. And every time I say Lloyd's of London, people say to me, oh, are they going to insure me the same way they insure like J-Lo's butt? And I'm like, not really. I'm like, Lloyd's of London is good for a couple of things. Occupations that are not traditional. So if you were a screenwriter and you didn't work for like a big place, you were just doing your own thing, none of the traditional disability companies are going to want you. So Lloyd's of London will say, well, we have a policy that's designed specifically for professional athletes, high income earning surgeons. So if you're a aesthetic plastic surgeon making $4 million a year, and you've got $30,000 a month of traditional coverage, maybe you even have $10,000 a month of like supplemental, and you're like, 40,000 a month, that's 480, 4 million. I'm not even close. They will make a policy available. It typically pays benefits for 5 years. And at the end of 5 years, if you elect it, there'll be a lump sum. So if you couldn't go back to, say, trauma surgery, it'll give you $2, $3, $4, $5 million. It's not inexpensive, but they're also using the same product for those that have health issues. So let's say type 1 diabetic. I finished my training. There's no GSI plan. I have no options. I don't have group insurance because I'm self-employed. Lloyd's of London will say, we will give you a policy. It'll pay benefits for 5 years, but it will exclude any complications related to diabetes. So I'm not going to say there's always something, because there are people that are uninsurable, but generally you can find coverage. And then it becomes a question of, if you can find it relative to what they offer, are you willing to pay for it? And if the answer is, I'm not willing to pay for it, then really what you need to do is you got to rapidly accelerate your savings rate to get to the point that you're financially independent as soon as possible.
And
right?
essentially stop insuring yourself.
Yeah. Or the other way of doing it along the same lines is, let's say you were involved in rental real estate. You had a bunch of properties and you were getting rents from that. well, that can become your disability insurance because that's unearned income, right? You're not working for it. You came up with the cash to buy it. Now it's coming back to you. Same thing for interest, dividends, capital gains, anything along those lines. So it's just a race to become self-insured at that point.
Any other questions from anybody else? Okay. Well, I just thought of one more question and then I'll ask and then we can probably finish up. For people like most of the people on this call, young people coming out of training, you brought up the issue about the life insurance and term life insurance. So you said something that kind of struck with me because I'm a single person with no partner and no kids. If I was coming out of training right now, I think, you've convinced me that disability insurance makes a lot of sense. But do I really need term life insurance if I've got no one to leave money to? If I'm coming
No,
at it 28, 29, 30, 31, 30 with nobody I need to leave anything for.
no. If unless someone is relying on your income, or you don't have a family history, everything is pretty good, then no. Like you really just don't need it. Like unless you're opening a practice or you're trying to take out a loan and the bank says like you want an SBA loan, you better have insurance in order to be able to close, then the only one that's going to really benefit from that transaction short term is going to be the person selling it to you. You just don't need it. Like the odds of becoming disabled are much, much higher than they are of dying at a young age. So if you're going to go on the defense and it's just you, your most valuable asset is you. That's where the disability insurance comes into play.
And Mark brought up a good point. Like if you have student loans and you've got liability, you don't want to leave that to your family. Then I think that's also a good point.
Yeah, because if they co-signed it, they're on the hook, for that. So I agree with that 100%. And I've had some people say, my family went to great efforts. They co-signed on my loans. I owe $500,000. If something happens to me, I don't want to leave that with them. That's not going to be my legacy to my parents. Yeah, then it absolutely makes sense. I honestly have not seen a lot of the co-signing these days. The other thing I'll throw in, unrelated to insurance, but very much related to financial planning, is student loans and public service loan forgiveness, right? So surgery residency is long. And on top of that, trauma surgery fellowship, it makes the long even longer. So now you're sitting at the end of the day and you're trying to evaluate, well, what job do I take? And let's say you have the ability to work, for a 501c3 nonprofit organization. And this could even be a private group that's inside a hospital, but you're actually getting paid by the nonprofit. If you only have to tough it out for a couple of more years to get your loans forgiven on a tax-free basis, and it just delays you going into practice for a couple of years, unless the delta is monstrous, I would tough it out and I would look to go for public service loan forgiveness. I see a lot of general surgeons or plastic surgeons opting to go into private practice when they are literally almost at the finish line of getting their loans forgiven. So that'll become a big factor. If you're finishing your training, you've got a significant amount of debt and you're trying to decide what to do, public or private type of thing. So if you have a financial planner, or believe it or not, this exists, there are student loan consultants, and that's all that they do. And they'll charge you for an hour of their time. They'll go through repayment plans. They'll go through different scenarios with you. And if all of this is like getting your eyes glossing over, that's going to be money really well spent. So.
Well, and that's a good transition. I'll just sort of, for everybody, we're kind of running short on time, so we're going to wrap it up. But it does transition into session 4, which for a transition to practice course will be in December. The date's not yet decided, but primary focus on that will actually be retirement and financial planning. So it was a good transition that Larry made. I think, we hope to sort of make this whole process iterative and sort of build on your knowledge to the next set. And so that'll be a big component for the next session. I put my information in the chat previously. I'll just put it in again. There's my email, my cell phone number. If anyone has any questions, any concerns, you want stuff you just don't want to bring up in this group chat, feel free to reach out to me anytime, 24/7. No one's bothering me. I'm happy to help. I got a couple of phone calls and texts after the last session. So I'm open and available, and as Larry's already put his information there as well. If you want to reach out to him, feel free. We're not by any means endorsing Larry specifically or his company. He is a resource available to you should you want to use them. If not, there's other people we can put you in contact with and people that we've used as well, or feel free to do your own vetting and information. The goal here is not to advocate for any specific person. It's really just to increase your knowledge, advocate for yourselves, and recommend that you do your own research and ask questions, but just start thinking about these things. It's not stuff that you're natively thinking about. I know that because I was there and I wasn't thinking about this stuff. So our hope is just to educate you guys and give you some knowledge and empowerment to go look for yourselves. But we're here. If we can be of help and resource, please feel free to reach out. The link for the first two sessions is there as well. If you didn't catch the first two sessions, they're available on the website. But otherwise, we thank you all for joining us this evening. Thank you, Larry, for spending the time and with us and giving us your knowledge and expertise. And I certainly hope all of you will join us for the next session in December. Just keep checking your emails. That invite will come out and the registration to link. And we look forward to you joining us next time.
Awesome. Thank you so much for having me. Mark, you were great behind the scenes. I appreciate the insight.
Thanks, Larry. Thank you, everybody.
Thank you. Have a great night.
Good night.
Thank you, Larry.
Thank you.